Namaste and welcome to a presentation on marginal costing. The main feature of marginal costing is classification of costs into two categories: fixed costs and variable costs. Variable cost is one which moves with the volume. Increase in the volume, increase in variable cost. Decrease in the volume, decrease in the variable cost. For example, material cost of a product. More you produce, more material required. Labor, more you produce, more labor. Less you produce, less labor. These are variable costs, which are also known as direct costs. And the second classification it makes is fixed costs. Fixed costs are not linked directly to output. They are remaining unchanged with the volume of output. For example, you give rent to the building where your facility is housed. The rent is related not to volume of production, but it is related to time. It is a fixed cost. Marginal costing makes this basic distinction. Take a cost, identify, is it related to output or is it related to time? In such an event, have the classification done properly, then what does it do? It treats fixed cost as period costs. Period costs means one which is related to time. Rent of a building. And it says fixed costs should not enter into decision making. It should be just charged off as a normal expense independent of production. It accrues based on time, and therefore it should be charged based on time. And second, it says value the stocks at variable cost only. Don't load them with your other fixed charges. And it says all decisions pertaining to pricing and determination of profitability has to be based on contribution approach. This approach states take variable cost, add a percentage to it to decide your price, and that percentage has to take care of your fixed cost as well as profits. This is where the contribution approach comes into picture. But in the practical field, in the long run, whether you pay it based on time or based on production, fixed costs have to be incurred, and anything that is incurred has to be recovered in the price. And that was the basis for the conventional costing or traditional costing, where we calculate the total cost, add a percentage of it as our charge or profits. And that is where we called it as absorption costing. In the long run, you have to recover both fixed costs as well as variable costs. And therefore, the relevance of absorption costing. And marginal costing as such is not a system of costing. It is a decision-making tool. It is a technique, and it has to be used along with methods and systems of costing such as job costing, process costing, and standard costing or budgetary control, which are continuing to exist. This is an add-on tool to make you take better decisions. It is a decision-making tool depending upon the nature of expenses. And in today's world, the quantum of fixed costs is increasing, and it is quite sizable. You take IT industry or you take any automotive industry, investment in fixed assets is in a big scale. You may call it a sunk cost, but it is a massive cost. Therefore, any decision that you take on pricing cannot be just ignoring such a massive cost involved. You may not be taking a realistic decision if you ignore the fixed costs. That is where they say marginal costing may be a fantastic tool, but it cannot be totally ignoring the fixed costs on products, because today it is not the time of variable costs, it is the time of fixed costs. This raises a fundamental doubt on the viability of marginal costing as a decision making tool. Marginal costing talks of a special concept called CVP relationship, cost, volume and profit relationship. The entire exercise is aimed at establishing a relationship between the volume, the variable cost and fixed cost, and the amount of profit which we are going to earn. Now this is easy to understand from a graph. Let us take an illustration to understand it better. Here in this illustration we have got different units sold. First instance 0 units sold, 100, 200, 300 up to 700 units sold. Say we can go up to 1000 units. And to produce 1 unit it costs me 1 rupee. Means first instance 0 cost, 100, 200 rupees, 300. This is the cost which is related to volume of production. We call it variable cost. Second, we have got a fixed cost of 300 rupees to be paid. It is a time related cost. Maybe the monthly minimum bill, monthly minimum salary, or the monthly minimum rent. Every month I have to pay 300, whether I produce 0, 100, 700 or 1000. And my sale is at 2 rupees per unit. Means at 100 units, my cost is 100 plus 300, 400, and I am selling at 2 rupees 200. Means here I am making a loss. My cost is 400, my sale is 200. In the third instance, 200 units produced, my cost is 200 variable, 300 fixed, therefore my total cost is 500. I am selling at rupees 2, 400, my cost is 500, sales price 400, I am making a loss of 100 rupees. I go to 300 units, I produce, it costs me 300, my fixed expenses 300, total becomes 600, I am selling at rupees 2, 600. Oh, it is a great moment where my cost and sales are the same. We will study this. As we proceed further, this 300 remains 300, variable cost keeps on adding, and we start making profits. Let us get into this. We saw there is a point here at 300 units, my cost is 600, which is 300 rupees variable, 300 rupees fixed, total cost is 600, and I am selling at 2 rupees, 2 into 300 is 600. And this point where the company or the plant makes 0 profit and also 0 loss. It is a position of no profit, no loss, and we have to remember it recovers entire fixed costs and entire variable costs. This is the position from where the relationship becomes very, very strong and yielding better results to us. What is this? This is where the cost is equal to sales. Break-even point is where you make no profit, no loss, you recover your cost. That is the break-even. Sale value is called break-even sales, and the units are called break-even units. And cost is break-even cost. The company breaks even. Cost is equal to revenue. Both sides, it is a win-win. Now, variable cost, it starts from 100, it goes to 200, 300, 400, 600, 700. This portion, which is indicated by this parenthesis, it represents the variable cost. And we have got fixed cost of 300 rupees, which is parallel to this. This is 300. and we call it as fixed cost. When you put variable cost and fixed cost, you get total cost. This independently, this particular line talks of variable cost plus fixed cost, which is nothing but total cost. Then we have got sales. Sales starts with 0, 200, 400, 600. It keeps on rising till it goes to 1400. This is the sales line. Now between sales and variable cost, we have got a concept called contribution. Means sales minus variable cost is contribution. What is contribution? Contribution is towards fixed cost and profit. When you add profit and fixed cost, it becomes contribution. When the contribution is less, it is fixed cost minus loss. Therefore, till you come to break even, you have got loss because your cost is more than your price. Here the cost is 500, sales is 400. 400 cost, 200 sales. 300 cost, 0 sales. This is all points of loss. Below break even, there is the loss. Above break even is the profit. And our aim is always to go above break even. And our marginal costing and cost volume relationship talks of this area from break even point and beyond. This is what we have to remember. And there is an angle here. Say this is around 25 degrees. This angle talks a lot of things. It is called angle of incidence. What does angle of incidence mean? It is 20 degree or 25 degree. Supposing it becomes 40 degree, 45 degree, it widens. Wider the angle, higher the profits. Therefore, we need to take decisions in such a way that this angle is widened. How do you widen it? You widen it by bringing down cost line or by taking up sales line. Either you have to move this up or you have to move this down or control both. This is what is talking of cost volume profit relationship. And as we see, the variable cost keeps on moving up. Total cost keeps moving in a uniform rate along with the sales. And as we saw, cost volume profit relationship, which focuses more after the break-even point, it talks of impact on net profit. The profit gets affected when there is a change in selling price. So if the price goes up, it is relaxed, it widens. If the selling price comes down, it is squeezed. Therefore, it affects the selling price. It affects the profit. When there is change in the volume of sales, as we saw at 700, it is at this level. At 800, it goes up. At 1000, it goes like this. And cost also goes like this. Means change in volume increases the sales. If there is a fall in the volume, it is squeezed. This is studied by CVP relationship. Change in the variable cost. This is the variable cost. If this goes down, we are incurring 1 rupee as our variable cost. If it comes down to 80 paise, this whole line comes down. If it comes down, the fixed cost parallel line also matches with it. Then the profit will go up because the angle becomes bigger. In all these three cases, what we feel is when the angle gets bigger, the contribution also gets bigger. And we study the impact of change in selling price, volume, and variable cost on the contribution. And what happens when the fixed cost changes? When fixed cost changes, when it comes down, it affects the profit. It goes up also, it squeezes the profit. It affects the profit directly. Now, this is being studied in CVP relationship, cost, volume, profit. We talked of the volume, we talked of the variable and fixed cost, and also we talked of its impact on the profit. There is one more thing called margin of safety. We are not profitable at break even. We are safe at break even. The more sales we make, we get more of profit. Profit is like a cushion. The more the cushion, the margin of safety is more. It is just like a cream on the bread. The more the cream, more margin of safety, more enjoyment. Now we can look at it just like a cot. This bed is just like a break even. If I put a mattress on the top of it, the mattress on the top of it is my comfort. It is my safety. It is my cushion. The total height of the bed is, say, 2 feet. And if the mattress is 1 feet, means I have got a mattress of 1 feet in a total of 2, means my margin of safety is 50%. Means, what does it mean? I will be safe till I break even. For a mattress to come to the break even level, even if I remove the mattress, I have got the break even here. 1 feet gone, still I have got 1 more feet. This talks of 50% is margin of safety. If my sales of 2 falls by 50% and it comes down to 1, still I am at the break even. My break even level is here, half of it. Now margin of safety, if you take it here now, my break even is 600. At a sale of 800, I have got a cushion of 200. 200 out of 800 is 25%. This is called margin of safety. My comfort is to the extent of 25%. If my sale falls by 25%, say 200 rupees gone, still I am safe because I am within break even. Come to next level, 1000, my break even is 600. I have got a cushion of 400. 400 over 1000 is 40%. Come to the next level, 600 units being sold. I have got a sale of 1200, but my break even is 600, means I have got 50% cushion. Even if my sales falls by 50%, I am within break even. Similarly, it moves. Higher the margin of safety, lower the risk. Lower the risk. More profitable the company is, higher the margin of safety. Marginal costing uses basically 3 equations. The first equation is the equation of contribution. Contribution is nothing but sales minus variable cost. Sales revenue minus variable cost. Now this contribution is used for what purpose? It is used for recovery of fixed cost and profit. In which order? First it covers the fixed cost. After covering the fixed cost, then it leads to profit. This we have to clearly understand. What happens at the break-even point? At the break-even point, there is no profit. We are only recovering the fixed cost. Therefore, at break-even point, contribution covers fixed cost, therefore is equal to fixed cost. There is also a concept called cash break-even point. See, fixed expenses may be non-cash or cash. For example, if it is rent, it is a cash fixed expense. If it is depreciation, it is a non-cash. Retail businesses and businesses of similar type normally aim at cash break-even, not to lose cash in the short term. Under all circumstances, there should be no cash loss. Therefore, their fixed cost will be mainly cash fixed costs. As we said, cash rentals that we are paying, I should recover that in the first place. In such a case, my contribution is equal to cash fixed cost. Invariably, fixed cost is both cash and non-cash. But when it is specifically said we want to calculate cash break-even point, then we should ask a question, what are your cash fixed costs? When my contribution is equal to cash fixed cost, I have achieved my cash break-even point. The first equation is Sales minus variable cost is equal to contribution. Contribution equals fixed cost at break-even point, and beyond break-even point, contribution covers fixed cost and also profits. Second is PV ratio, profit volume ratio. Once again, it is going around contribution only. Contribution divided by sales into 100 is PV ratio. Very, very simple. Contribution divided by sales is equal to PV ratio. Then this PV ratio may be also having its variants. If the problem gives you data for 2 years and it says contribution for 2 periods and sales for 2 periods, then what we need to do is, if it is given for 2 years, we have to find out what is the change in contribution from year 1 to year 2, what is the change in sales from year 1 to year 2. One divided by the other is called PV ratio. PV ratio is contribution by sales, or when it is given for 2 periods, change in contribution over change in sales. Sometimes change in contribution is not available. Change in profit is available. Profit for 2 period, sales for 2 period is given. Then instead of contribution, you call it as profit. PV ratio in its original form is contribution over sales. When it is given for 2 periods of the same company, we can derive PV ratio by having change in contribution and change in sales over the 2 periods, or where change in contribution is not available, profit is given, change in profit over change in sales. Basically, it is contribution over sales, change in contribution over change in sales, change in profit over change in sales, but the ratio is only one. It is PV ratio, profit volume ratio, which is also called as contribution ratio. Third is margin of safety, which we saw. Margin of safety is the height of the mattress in the total height, that is break-even sales as deducted from total sales. It is also known as profit by PV ratio. Margin of safety is break-even sales as deducted from total sales, and it is also indicated as a ratio or percentage. Margin of safety divided by total sales is called margin of safety ratio. Suffice to remember that the cushion which is available on the bed, which is nothing but total sales minus break-even sales, that is the margin of safety. If sales is not available, we can derive the margin of safety by dividing profit by the PV ratio, which we will see in the problems. Therefore, the 3 formulae to be remembered: sales minus variable cost equals contribution, PV ratio equals contribution over sales, margin of safety is total sales minus break-even point sales. That is the margin of safety. With these 3 equations, you can solve any problem in marginal costing. In this problem, there is an investment of 1,50,000 and there is an expectation of 15% profit on investment, and there is a variable component of 60% of sales as variable cost, and fixed costs are 75,000 per year. The question expects us to calculate the break-even sales volume, target sales volume to get a 15% return on investment, and if the fixed costs are irreducible by rupees 25,000, then what should be the sales to be achieved for a break-even with a reduced fixed cost of 75,000 minus 25,000. Let us take up the solution. Mr. Young has 1,50,000 investment in a business. He wants a 15% profit on his money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of sales variable cost over sales is equal to 60%. His fixed costs are 75,000. Show supporting computations for each answer. What sales volume must be obtained for break-even? Question number A is, what is the break-even? Break-even formula is fixed cost divided by PV ratio. Now, what is PV ratio? If the variable cost is 60%, PV ratio is 1 minus variable cost, which is nothing but 40%. Means variable cost plus PV ratio is equal to 1. Therefore, PV ratio is 40%. Break-even equals fixed cost divided by PV ratio. Fixed cost is 75,000. PV ratio is 40%. Therefore, break-even sales is 1,87,500. Second question, what sales volume must be obtained to his 15% return on investment? Now, the sales has to get us two things. Contribution has to cover fixed cost and profit. What is the fixed cost? Fixed cost is 75,000, as we have seen. Profit is 15% of investment. Investment is 1,50,000. 15% of it is 22,500. 75,000 plus 22,500 divided by PV ratio is 40% is equal to 2,43,750. Come to the third question. Mr. Young estimates that even if he closed the doors of his business, he continues to incur 25,000 as fixed expenses. Therefore, reducible expenses is to the extent of 75 minus 25, means 50,000 is the fixed cost which are irreducible. Now, if he wants to have the closure of his business with a fixed expense of 25,000, means he has to recover 50,000 as the fixed expenses divided by PV ratio 40%. He should achieve a sales of 1,25,000, and that is the answer for question number 3. In the process, we have seen the equation for break-even, for target contribution towards fixed cost and profit divided by PV ratio, minimum fixed cost divided by PV ratio when the fixed cost cannot be reduced beyond 25,000. Now that is regarding illustration number 20. Let us take one more illustration where we said when the figures are given for 2 years, the formula changes. 2014, 2015, calculate the profit volume ratio and also other cost figures. It is simple. Let us start. The following figures relate to a company. Here we are given 2 years, 2014 and 2015. Let us make it vertical, putting the figures in the two places. Total sales 22,23,000, 24,51,000. Incremental sale is 2,28,000. Then we have got total cost 19,83,600, 21,43,000. Incremental is 159,600. Then we have got the profit. Profit is the difference between the two. Sales minus total cost is equal to profit. We derive the profit. And profit is 239,400, 307,800. Incremental profit is 38,400. When we saw the PV ratio, we can take it as contribution over sales, or change in contribution over change in sales, or change in profit over change in sales. One of these three. Here we are using change in profit divided by change in sales. That gives us a PV ratio of 30%. Once we have the PV ratio, we can derive the contribution. How do we do it? PV ratio is nothing but contribution divided by sales is equal to PV ratio. Now, when I have got PV ratio, when I have got the sale, if I multiply the two, I will get C. C equals PV ratio into sales. PV ratio is 30%. Sales is 22,23,000. Multiply the two, you get 6,66,900. 30% of this is 7,35,300. Now, once we do that, we have possibility of getting fixed cost. What is fixed cost? Fixed cost is nothing but contribution minus profit. 666 minus 239 is 427, and fixed cost has to be the same for both years. Here once again we can cross check that 735 minus 307 is 427. Once you do it, break-even point is easy to do it. Fixed cost divided by PV ratio. Fixed cost is 427,500 divided by 30%. Break-even is the same for both the years. What is margin of safety? Margin of safety is nothing but sales minus break-even sales. Now sales is 2223 and break-even is 1425. 22 lakhs minus 14 lakhs, 7,98,000 is margin of safety. Similarly, 24.5 lakhs minus 14.25 lakhs is 10,26,000 is margin of safety. Margin of safety percentage is as good as margin of safety divided by total sales. 798 divided by 22,23,000 is 35.9%. Here 1026 divided by 2451 is 43.9%. What is the variable cost? Total cost minus fixed cost is equal to variable cost, or variable cost is also sales into 1 minus PV ratio. This is another way of doing it, but this is a simple way. Total cost minus fixed cost, that gives you variable cost. These parameters could be easily found out by simply knowing those three formula, or one formula is enough for you to derive the entire thing. What is PV ratio and how it is derived? That helps you to achieve the answer. Let us go further. There is one more problem here now. Dynamic company has three divisions, A, B, C, and they have got this cost structure. This is simply total, they have put it now here, cost and sales. The management is considering to close down division C. Now what happens if it is closed down? We have to see it from the point of view of marginal costing. Let us get going. The dynamic company has three divisions, A, B, C, and let us have one more, company as a whole, total. What is the sales? Sales is 1,12,000, 56,000 and 84,000. We make the posting. Total sales is 2,52,000. Direct material, direct labor and direct expenses, these are nothing but variable costs. We post all of them in the respective places. Our variable cost is 33,600, 21,000, 64,400, 1,19,900. Contribution, we know for sure. Sales minus variable cost is contribution. We derive contribution and we calculate PV ratio for our satisfaction. What is PV ratio? Contribution divided by sales. 78,400 divided by 1,12,000. 70%, 63, 23%. Now going by PV ratio, contribution of division C is the lowest, and therefore they have decided to close down division C. Now before we get into that, let us find out what is the fixed cost. They have put it under three products. As per marginal costing, we don't allocate it to divisions. It remains total as a time cost. It is kept for the company as such. Remember this point. There is no need to apportion it to different product divisions. It is a fixed cost. Fixed cost is for the company. It is not for product divisions. 70,000. Now contribution is 1,33,000. There is a fixed cost of 70,000. We are making a profit of 63,000 when we are working all the three divisions. Now the company says they want to close down division C. If they close down division C, let us see what happens to contribution. Contribution, division A will remain 78,400. Division B will remain at 35,000. Since division C is being closed, contribution will be nil. What will be the total contribution earned by the company? 1,13,400. These two divisions. Fixed cost remains unchanged, 70,000. And what is the net profit? Net profit will be 43,400. Now, when we were operating all the three, division C was contributing towards profit and fixed costs 19,600. By closing that division, we lost that contribution. To that extent, the contribution came down and our profit fell down by 19,600. Is it worth closing? You are better off continuing what you are doing today. If you close, your profit will come down because division C may be doing a lower contribution, but it is contributing towards profit and fixed costs to the extent of almost 20,000. And the company, whether or not division C should be closed, division C should be continued to be kept open. It cannot be closed because if you close, you will lose its contribution. To that extent, your profitability will come down and the decision is not favored. Let us go to one more problem. The manager of a company provides you with the following information: sales, variable cost, fixed cost, profit before tax, income tax, net profit. The company is thinking of expanding the plant and the increased fixed cost is 40,000 and the maximum production in the new plant will be 2,40,000. The company wants to earn an additional income of a minimum of 3,200 rupees. On the basis of computations, give your opinion on the plant expansion. Here, the simple thing is that with doing all these, the company wants to earn over and above what it is earning today. It is earning 32,000. They want to earn minimum of 32,000 plus 3,200. That is 35,200 rupees is what is their target profit. We have to do it from the marginal costing point of view. Same template we will keep. Let us post the figures. Sales is 40,000. There are two things. One, existing company, we want to expand. What is the total and what is the result? Sales is 4 lakhs. We are posting sales. We are talking of as it appears here now. Cost of variable expenses is 60% of sales. 60% as given, 60% of 4 lakhs is 2,40,000. We post that figure. And we know sales minus variable cost is contribution 1,60,000. What is fixed cost? Fixed cost is 80,000. 80,000, if out of 1,60,000, 80,000 is the fixed cost, your profit before tax is 80,000. They have said net profit is 32,000. If profit before tax is 80, net profit is 32 and difference is income tax, how much it is? First make the posting of net profit 32,000. Difference between these two is income tax. If 48,000 is the tax on 80,000, tax percentage becomes 60% of PBT. This is what is required to be done here. We have done it now. Then go to the second para. The company is thinking of expanding the plant. The increased fixed cost with plant expansion will be 40,000. Means the fixed cost that is going to come additionally will be 40,000. We post it here. It is estimated that the maximum production will be worth 2,40,000, means sales from the new plant will be 2,40,000. The company wants to earn 3,200. Okay, let us keep it in the background. Let us come here now. Expansion, we know the sales and our relationship is 60% of sales is variable cost. 60% of 2,40,000 is 1,44,000. Contribution is coming to 96,000, 240 minus 144. And fixed cost is posted as 40, 96 minus 40 is 56. And we know 60% of the profit is going to be tax based on the last working. 60% of 56 is 33, and we are making a profit of 22,400 additional. What was our target? To do 3,200, whereas we are making 22,400. Total profit will move from 32,000 to 54,400, much way beyond the company's return on invested expected. And this is how a marginal costing presentation will make it impress you, and there will be success. As we have seen, profit increases much beyond the target of 3,200. Hope you enjoyed the presentation. Thank you so much. Thanks a lot.